And it is time for the Word on Wall Street. Top investors watching your money. Joining me right now is Markowski Investments President Chris Markowski, Payne Capital Management President Ryan Payne. Great to see you, gentlemen. Thank you so much for being with me. And Chris, I'm kicking things off with you with that pretty good move for the NASDAQ. In fact, we're talking about almost a 3-week gain. Best day in more than a week yesterday for the NASDAQ. But you've seen a bit of a pivot on growth. Elon Musk's 9.2% Twitter stake prompting investors to snap up tech, social media certainly. Tell me about this. On Twitter, up 1.33%. It comes less than 2 weeks after Musk criticized the company. He first tweeted a poll about whether or not Twitter adheres to free speech principles. Look at this poll. Free speech is essential to a functioning democracy. Do you believe Twitter rigorously adheres to the principle? 70% said no. He then tweeted, the consequences of this poll will be important. Please vote. Then we find out he has amassed 9.2% of the stock. What is he doing here, Chris? What's your reaction?
Well, I think he's stepping into a void. He sees something. There's been some failures, obviously, as of late in regards to new social media companies coming out. And Elon Musk does get that old meme stop thing there, the diamond hands. Anything he touches seems to do pretty darn well. And I think that this is a case. And I think many people out there that are kind of hoping that we can head towards a social media that there isn't as much censorship, there isn't as much cancel culture. He might be the savior for that. He's definitely taken a libertarian stance when it comes to politics, and I think that's attractive to a lot of people. And if they can move Twitter in that direction, I think it'd be great.
Well, look, I'm wondering if he's looking to take over the company is really what I'm asking you here. Because, look, you've got 9.2% of the stock now owned by Elon Musk. That he's the largest shareholder, even more than the CEO. Jack Dorsey. Yeah. So, I mean, initially he was, saying I might start my own social media company. He was tweeting that a long time ago when he was frustrated with Twitter and how they censor so many things that they don't like. So that's really what I'm asking. I know you don't have the goods in terms of what the bankers are up to, but I'm wondering if this is a reason to buy the stock, that there could be an acquisition at some point.
Yeah, a big run up as of yesterday. I'm sure that there's going to be some profit taking moving forward. But yeah, I definitely think that could be in the cards. The guy is very eclectic when it comes to his investments, without a doubt. And again, it's going to be some time before he's going to be able to take full control over the company. I just think if he heads and pushes the company in that direction, I think it'd be great for the overall social media and internet as a whole.
Yeah, I want to get your take on growth overall and tech stocks. But let me bring in Dennis Gartman here, the former editor of the Gartman Letter, is here with us. Dennis, we're looking at a market that is waiting on second quarter earnings. We, of course, get those earnings beginning next week. What are your thoughts on the quarter that was in the first quarter? And are we going to see lots of Russia conversation? Jamie Dimon mentioned the Russia losses that could happen in his annual letter yesterday. I'm wondering if this is going to be a theme for the banks. What are you expecting?
If it weren't for the fact that we have such geopolitical circumstances, we'd have had the Fed already tightening by 25, 50 basis points, and we'd be assured of 50 and 50 going forward. We'd probably have the overnight Fed funds rate by the end of the year at 3.5% or higher. But geopolitics is playing an enormous role at this point, and well, it should be. So it's probably having a deleterious effect upon, or shall have a deleterious effect upon earnings going forward. You had ExxonMobil come out with very good earnings last night. That was very impressive. Perhaps we'll see a strengthening of the energy markets over a period of time. I'm not very amenable to the stock market generally at this point. I've been bearish since January 5th because we had a technical circumstance that occurred that I found very important, an outside reversal week. And I think that we had far too many people in the public involved in the stock market. We had an aggressive amount of bullishness at that point. And to me, I'm really quite bearish on share prices. I think that the rally that we've had for the past 4 or 5 weeks has been on very small volume. And good bull markets go up on big volume and come down on light volume. This has had a market where we've gone down on big volume and up on light volume. So I would just continue to tell people, be very careful. An inverted yield curve and rising interest rates are deleterious to share prices on balance.
Yeah, I know you've been saying that, and certainly the beginning of the year certainly reflected those worries as well. I'm wondering if the housing market is giving us that clue right now, Ryan, because these housing stocks, these building companies have been rolling over now for a couple of weeks. The housing industry now holding the lowest price to earnings ratio in the stock market, about 4 times projected 2022 earnings. I know that you think these stocks look dirt cheap, and they were up yesterday, but they've been indicating that things are slowing down. You've got mortgage rates at highs that we haven't seen in a little while. And that's going to continue as the Fed raises rates. Why would I want to buy housing companies right now?
Well, you're right. It's been a horrific sector to be in this year, Maria, down 24% for the year. But here I am, being the contrarian as usual. And I would say here, and I did talk about this a little bit last week, is the housing market is going to stay strong regardless. You know, interest rates are definitely going up. I agree with that 100%. Mortgage rates now 30 years over 4%. In some cases, you're getting a 4.5% 30-year mortgage. Now, to put that in perspective, last time mortgages were over 4% on the 30-year, we had 1 million more houses in supply than we have today. The market's so undersupplied right now. If you look at housing stocks like Toll Brothers, for instance, it trades for almost exactly price to book, extremely cheap here. And that's the more affluent market. So their average sales price is like $1 million, which, if you're $1 million home buyer, you're probably a little less sensitive to interest rates. So, I think if you want to be bold here and you're looking for bargains in the market, that's probably a really good place to look. Housing stocks were up 50% last year. I see them rallying big this year as we move along this year. Because again, my take here is the economy is going to rock by the summer. And you're going to see inflation come down a little bit from the heights that we've seen recently. So you are going to see a little bit of a soft landing here. And housing is going to be a big beneficiary of that, along with the fact people are just going to travel like crazy this summer. So this all bodes well for the American consumer. Every week, as Dennis gets a little more negative, I get even more bullish. Sorry, Dennis. And I think right now you want to be invested. I know. As my tagline says, be bullish.
That certainly is what makes a market, gentlemen. Chris Markowski, I'm coming back to you. Wrap us up here on which sectors you like. We talked about Twitter earlier. Does that mean you like growth and tech in general, or are you being selective as well?
Oh, I'm always selective when it comes to growth, and it's in particular in growth in tech. I like companies that are making money, and I think that that's going to be the trend this year as well. We're actually going to see it as well in the IPO market, where some of the IPOs are going to be going public this year. It's going to be a diversion from the past. They're actually going to be in the black. That's the good one, not the red, which is the bad one. So, yeah, I do think that growth in tech is great as long as you have companies that are making money. I think people are going to be a little bit more particular heading into this possible recession that we get. And I also want to remind everybody as well, everybody treats recessions like it's a monster coming out of the woods. Markets do pretty well during recessions because they anticipate coming out of the recession. If you take a look, recession after recession after recession, markets tend to do pretty well. They sell off coming into them and do well through them.
That's an interesting point, Chris. Thanks for making it. All right, gentlemen, good to see you all. Thank you so much. We appreciate your time. Chris Markowski, Dennis Gartman. Ryan, you're sticking with us, and we're so grateful to you for that. Stay right there. You're with us all morning long.